Hello and welcome to episode 15 of PJS Mortgage Mythbusters. I'm reading that off the board from our nice little post that we've got logo because we haven't done this for so long that we're having to remind ourselves how to do a podcast.
Tell you what, that theme tune sounds good though, doesn't it?
Oh, it's brilliant. I can't believe it. I'm actually starting to listen to that in the gym. I think it's on Radio 1's top.
Works on a lot of levels.
It does, aye. Brilliant. We'd love your feedback on that as well.
Yeah, please.
So we're going to make this is the shortest one ever, so we promise you can get back to your normal podcast, but 30 minutes, and I think it's appropriate to explain why we haven't been doing this, but let's just use the same format as we always have. So the last podcast we did was episode 14, and it was that your rate is secured when you get a decision in principle. One of the big things I talked about there was hoping that all lenders followed suit, where you could actually secure a rate at decision in principle, which was nationwide at doing it. Not many lenders are doing it. Faz is here today. Hello, Faz.
Hello, hi Rob.
He's featuring on a couple.
Third one, I think.
Third one. I'll just put you on the spot. Does any other lenders do it other than nationwide, where you can secure the product at decision in principle? It was a feature I thought would catch on because I thought it was a way to price your products. And what a great way for the lenders to go, we've got this much money, we need to stop lending that money, we need to change our rates. Instead, they let them secure it, and then they go to application, and you just can all do it. So, but they've got big boots.
A really good feature though, when the mortgage rates were different to what they are now. I think in a market where as interest rates were going up on every other day, really, really useful feature. Nowadays, probably not as much utilised because even if you secure a rate with Nationwide on a dip, 2 weeks later or a week later, it's probably lower interest rate.
Yeah. So it was working in the customer's favour before, but now it probably wouldn't.
And do you know when we say...
Yeah, exactly.
When we say before, we're talking a couple of months.
Yeah, 2 to 3 months.
When we did the last podcast.
But again, interesting that if you're using a broker, then your broker will have to do fresh research at the time of application, which will identify the need to pick the new lower rates. Whereas if you maybe have gone direct and the system direct allows you to secure the rate on dip, then you secure the house a month later, you may actually go back in and apply on a higher rate than necessary, unless their system insists that you pick a rate from the current product range, which it should do.
And it's good to point out that Nationwide, and we're not publicising them, we're not picking on them, but if you're doing it on your own, you have to leave a window when you cancel it to repick the new one. It's actually easier through a broker, and they'll tell you that, and that's from experience.
So elaborate on that then. So if I come to you, you'll do the research, you'll tell us their rate's gone down, but you're saying if you're doing it as an individual going to them, are you saying if you decide not to go with that rate?
To do what we just click a button and secure a new rate. Whereas as an individual, if you're doing it direct with your bank, it's a lot harder.
Right. Okay.
Basically, the interface that they've invested in the intermediary channel is better. But it's just, that's all lenders as well. So like sometimes it's easy just to pick up the phone and say it. HSBC, you type something on live chat and you can change the rate. But it's just interesting that Nationwide we're talking about in a positive. Actually, when you go direct, it is a pain in the ass. And that's from knowing someone very close. Well, staff members, other half, that is wishing they came to us.
Yeah. So just before we go on then, so how has it changed? You said there a couple of months ago it was all going up. I obviously just see the odd snippets that are in the news. Is it looking much rosier than it was?
Odd snippets.
Yeah. Well, you know what I mean? Odd snippets every day. It's on every day, isn't it? It's always talking about it, but you become a bit more immune to it. Is it from a company point of view and from you seeing these cases day in and out, do you think, is it looking a lot rosier than it was?
We'll talk about that in the new myth. That's what we do.
Right.
But it's good that this is the last one because it actually explains why we've took this long to get around to doing it with the work that you've done and the support that we've had to give customers, whether it be in the website or just in marketing, into staffing and just manning the phones basically. But that's what we'll do. We'll jump back into the myth because it's going to be a short one. But the myth today is PJS have stopped doing Mythbuster podcasts. I'm going to bust that by doing one.
Why, Paddy? Why have you stopped doing it?
Good question, Baz. To be at time, 6 weeks holidays didn't help because it went quiet but it didn't stop inquiries, but the inquiries weren't transactional. In fact, towards the end, yes, a lot of purchases, but it was more inquiries like you would expect. And as rates started to come down, customers not shopping about, sitting on the fence waiting.
Yeah.
And that's what we needed to kind of use you for with marketing and things like that, and on the website to educate people and say, yes, they will come down because the news is saying that, and let's just all believe the news because they never tell any fibs. But it was more the point that that's the worst it can be. So let's lock in it there, and it'll be.
The need for advice has always been there. It still is. People, there's so much uncertainty that they still want to speak to you, which is taking up the time, manning the phones, doing all the dealing with
so
inquiries.
So is this back to almost like it was when we've said on past podcasts when it was like COVID times, and you're more like an arm around the shoulder, you're more like like reassuring people, and they're not you're not actually ending up doing anything for them, but you're just giving them advice rather than.
For me, it's preparing people, right? Particularly the ones who are coming out of their deals and are really concerned because they're still hearing news about inflation. Yes, sticky and inflation not coming down. And rate, the Bank of England, although they kept the rates at what it was 5.25 the last time, first time in 14 months.
But it was cheap. They thought it would go down. They thought it was going to.
So I think people are still hearing news that the interest rates and inflation and cost of living is all in the press. But for me, speaking to the customers is preparing them for what's due to come in 6 months' time. And we're contacting them 6 months before their new rates coming. So yes, people are wanting to speak to us, but it's not a case of just hang fire, everything will be rosy in 6 months. This is what it looks like now. We believe it. Hopefully, it's worst case scenario. It may be better by the time you need to switch to another lender or switch deals with your current lender and stay with your current lender. But it's having those conversations early so people can prepare themselves for it should the time come.
Whereas now the difference is now if you're in a 10-year fixed and you secured it last year, actually, let's say 13 months ago, you're laughing. You secured your 10-year fixed and you're not moving, you're thinking, I've got a great deal. In COVID, people with a 10-year fix were still calling up and saying, how am I going to pay my mortgage? Because they were worried about the job and impact, and we couldn't help them. But it was it was supporting them with like, how do I contact my lender? Because I can't get through. You can't. And we were given a lot of material to actually help them and support them, which was only a number that they had to call. But it was like the unknown because you didn't know. And at the same time, we still don't know. I think everyone's been wrong. I love it when the banks come in. We've got Metro Bank in today. We had HSBC in last week. And I think
is this actually coming into our meetings with
banks? Yeah. And then we had Precise at the beginning of this week. No, it wasn't. Yes, it was. Precise.
Let's say it was.
And we'll just pretend it was. We're just making this up anyway. And they are surprised at how wrong their economists have got it. And they are thinking, like, what is going to happen next year? They all know that the remortgage business is going to be great so we can get competitive. But they don't know what the government's going to do. They don't know what is going to happen to house prices.
So we're still no further forward in knowing the way it's going to look.
It was interesting. Somebody said a brilliant quote was economic forecasting is only there to give astrology some credit or credibility.
I like that.
It is because how far off have some predictions been? And I think all we can do is, we get asked this question all the time by clients. What will rates be?
Yeah, of course.
And as the lenders come into the office, that's the first question I ask. What's your predictions? What's your economic forecasters saying where rates will be in 12 months, 18 months, 2 years' time? I think now, as things are starting to settle down, particularly with the swap markets and how they affect the fixed rates, there seems to be more of a general consensus amongst the lenders as to where rates will be. They'll never put their neck on the line. But
again, it's still guesswork, isn't it? To an extent.
Exactly.
It's educated. You just wouldn't put your life on it. I'd put my own mortgage on it, but then I suffer the consequences and I can sleep at night. It's the fact that we're having to deal with customers and they're relying on us to give them the answer to something that's.
And is this unprecedented? Because I mean, obviously, I'm no sort of well versed in mortgages and things. Has this just happened all the time and I've not been aware of it, or is it something that's because everything seemed to be going rosy for so long, didn't it?
Yeah,
we've mentioned before.
We're going back since 2007, 8. You mean? Because We had a little blip there.
So before then, was it very similar to this though? Was that another period like this where everything's up in the air?
A little bit, but the underlying reasons for why things happened back then are completely different to what they are now.
But was it more predictable? As
back
in,
then?
The outcome, or
I think it was less predictable. I think it was almost just thrown upon us, whereas here, I think a lot of people say COVID was the kind of initial, and then
like
inflation, and then the Ukraine war. I think there's a lot more factors involved in this that are outside of people's controls, where I think a lot of people blame the bankers back then. They knew it was it was a ticking time bomb.
But it just wasn't.
That was kind of brushed under the carpet until the proverbial hit the fan.
But I think with me, I'm trying to think when we got our first mortgage, I think that was around 5 or 6, 2005, 6 maybe. So we were probably locked in and it didn't register with us that much because we were safe, we were all right. Whereas this time, everyone seems to be totally affected by it. Everyone's...
100%.
It's crazy, like.
But if you're not affected by it, then you're locked in. That's the only way. When the amount of people, I think 2/3 of the mortgage population, this is from HSBC, and obviously that's a massively rough figure, 2/3 are still safe. It's the third that's out there that's having to deal with it. But if you think about it, that's because people generally take a 2, 5, and that's just
I think there's another little ticking time bomb though, because we've had 4 years-ish. I think in a year's time, if things haven't settled down, it's the ones, because most people, because rates were so low, I think the lowest they went, February last year, so 18 months ago nearly, would you say? You could get 0.99 5-year fixed rate with Santander.
Imagine that.
And it's ridiculous to think of that. So leading up to that, rates were so low, people were just fixing for 5 years. There's a huge trench of people coming out of those 5 years.
Well, we're one of them, aren't we? We've got a lifetime tracker, which is, I can't remember what it is, it's something like 0.89 above the base rate or something like that.
Which is now a high tracker, but everyone would have bit your hands off when it was 0.01.
It's mad. But then,
But it's not just the interest rates. I think it's the problem is compounded by other things where in COVID times, I've said this before, in COVID times where businesses were going to the wall, the government came out and said, let's all have a stamp duty holiday. So people pushed the boat out when incomes were okay, outgoings weren't as bad, utility costs and cost of living wasn't a major issue 4 years ago, before COVID, and pushed the boat and bought the ultimate house on 1-2% rates. Now, not only is their rate going to go significantly higher when they come out of the fixed rate that's been fixed for 5 years at less than, say, 2.5%, they've also got gas, electricity, the general inflation costs, and it's just going to be hit them from different angles. That's what I'm worried about.
Yeah, because that's the 2/3 that aren't in this mess at the moment. Having to think about it, and it comes and we can see it, and the closer people get to it, the more they're worrying. So they are contacting us, which is great, which didn't used to happen because people would just wait till the last minute. What's the cheapest rate? I'll take that one. Now it's, I need your help and support, and I suppose preparing them for what they need to do. Yeah,
making cutbacks in certain areas to accommodate what is going to come. Yesterday I had a text from a client saying my mortgage is due next May. Can we have a chat? God's honest truth. And I'm thinking, I like that. She's going to be really easy to deal with because
she'll have that foresight and
she already knows I'm the Grim Reaper, which I have.
She knows the worst. Yeah, she knows the worst.
We've had a few, because May's 5 months away from Christmas, and it's Christmas technically. Like I know that's mental.
That's how it's judged.
Christmas is when you need to start spending that pot of cash you've saved all year to spend on presents. And that's when Christmas starts and starts hitting your bank. So if you're thinking now, 6 months' time is May, that's...
Well, actually, she was delighted because when I looked at her mortgage offer, the actual end date of her fixed date is end of July. So in her mind, another 2 months of cheap mortgage payments.
So what you were saying there about people having to manage their budgets and stuff like that when they're coming off fixed rates, it's similar to what you said. It was either on the last podcast we did with you or the one before where you were saying these are the kind of things that people know they have to do when they go for the first mortgage. When they first get on the ladder, they know that they're not allowed. You're not allowed to do it. It's going to be harder for them to go out and drink every week. It's going to be harder. You have to tighten your belts a bit.
Clean your bank statements.
Well, this is it. But when people have already got, you've already got your property, you're already living your life, which you've lived for X amount of years. You've been tied in. you're then going to have the culture shock again of coming out of it, like you say, and then you've also got your gas, your electric, and all the other things involved. It's going to be, I mean, what feasibly would happen then? I mean, if people start defaulting quite a bit on the mortgages, would that then, do the banks then put their rates up if they're not getting as much back, kind of thing, or what happens? I mean,
not necessarily. They won't.
You got the mortgage charter, which, depending on how you read into it, could be catastrophic because it's just putting the problem further away.
But I think it is. I think the mortgage charter is actually a good thing. I agree with you. It's kicking the can down the.
As long as
so, what does that mean? What is
so in COVID, you're allowed to ring your lender and you could do things instantly and put things back. You could ask
without it affecting your credit rate.
The government didn't know what's going to happen and stuff like that. They've given that option on the mortgage charter where you can go interest only, extend your term. Forbearance and things like that has been delayed to 12 months instead of 6, so they can't come knocking on your door and say, give us the keys. So they need to put something in place, but it's not going to be a 6-month fix, and that's the problem. But I'm sure the government, being how brilliant they are, in 6 months' time they're going to bring out a revised version of what then happens next. But going interest only or extend your term doesn't make as much difference as you would hope.
Right.
Not only does it have consequences of the obvious of not repaying the balance, it's just the interest rates are high and people need to know what it's going to be. And that's, if you need to speak to us 9 months before to look at today, it's going to be helpful, but it's going to create a lot of worry. But you're probably worrying more by just jumping on and typing in calculators. You need to talk about your specific.
I mean, I was just going to say, I'm the way of, I would rather have the worst case scenario. And then kind of you almost plan for that, prepare for the worst kind of thing. But it doesn't, you say mentally, it doesn't do you any good, does it? If you're worrying for, as you say, almost 9 months or whatever.
It's no, but I think the lenders, it was interesting how quickly a lot of lenders adopted lenders always tell us it takes months and years sometimes to change systems to accommodate policy or change systems in the background to be able to be more flexible for clients' needs. Yeah. But with the mortgage charter, it was almost a lot of them instantly could now switch to interest only in the background. I wonder why that is. Is it because they know they're going to make more money on interest in the long run when the clients are extending their the mortgages for 2 years? Right, we're going to make more interest off this client. So I'm sure our system can accommodate that. However, interestingly, I won't name the lender. No. It's I'll give a little clue. It's a lender that didn't pay brokers a prop fee for doing product transfers. You had to send them back direct to them.
Understood.
Great lender, but recently started doing prop fees, and in fact have actually increased the prop fees they pay on product transfers sooner than most others have done. So they really adopted the product transfer fee. But although they're part of the mortgage charter, the product transfers can only be done within 3 months, not 6 months, which is one of the things.
Yeah.
Which when I questioned them, they said it's a voluntary thing. As long as you are working towards allowing them to do it 6 months in advance and don't have it in place, you can still be part of the mortgage charter.
So this 6 months in advance, that means if mine was due to run out in December, say, I can change products without being charged. Is that what you mean?
That's what the government wants, which to be honest makes sense. Like it used to be 3 months, but that was plenty of time.
No,
when rates were good.
Important to clarify that you can secure a new deal for when your deal comes up in
December.
So
it's still in December, but you would know what you're going to get. Basically.
Exactly.
Right.
And the good thing is, so let's say you secure it in July, 6 months in advance. If rates come down, you can continue to keep swapping.
All right, so you're not stuck on that. It's not like shit or bust.
There were a couple of lenders that said if you select a product, that's what you're getting, and if you want to come out of it for a better rate, you then have to pay the penalty.
Okay.
But I think
So just going back quickly for novice like me, for interest only. So usually you're paying off a bulk of the interest every month and a bit of the capital that you borrow. With interest only, you're literally only paying the interest that
borrow
you
100 grand, you pay a payment, and the 100 grand's still there in 25 years. Yeah. Not uncommon back in the day.
I totally get it, and I've heard of people doing it. So is it kind of like a stopgap just to get you back on your feet? Do people use it as that kind of thing? Do you know what I mean? Do you
know what? You can use it to your advantage, and it can work very, very well. Buy-to-lets, for example. You're using the mortgage as a vehicle, and you're hoping in 25 years that property price is higher, you're paying the interest by the person paying the mortgage, and the difference is your business. That's just the business. But on your house, the idea is you're living in it, you want to pay it off. At the end, it's a mortgage. That's what mortgage, the definition of it is, to repay it. But in terms of an interest only, if it was 0.9%, wow, that's cheap. And the difference between a low interest and 6%, 1% and 6% is huge.
So what's that, like a grand?
So in terms of, if you were paying £1,000 today, and your interest rate was 6%, then roughly you'll be paying about 50 quid off your mortgage each month.
Right, okay.
Yeah, on repayment. So your interest would be, just argument's sake, £950.
Yeah.
Just in
so if you went for interest only, you're only paying £950 a month.
You pay £950 a month, but it's going to the bank for for the rent of your mortgage. But 50 quid would be going off your balance. Yeah. Reverse that to 1%, you'd be the opposite way around. You'd be paying maybe 100 quid interest, and you'd be paying 900 quid off your mortgage, which is great.
Just a disclaimer that the figures aren't accurate.
Give us the figures.
It's not.
Yeah, go on.
No, because what I'm trying to get is, for every 10 quid that you're paying, at the moment, 9 quid is interest and 1 quid is coming off your balance. Whereas it used to be the opposite. And I did a quote to a customer last night for 400 grand interest only, and it was 2,050 quid a month at 6%. What's repayment? Well, actually, so £400,000 over 25 years repayment, same figures, was 2,600 and something. 2,600, so only £600, well, let's say £550 was coming off repayment, whereas the other was interest. But when it was 1%, you were talking the complete opposite. Every time you were paying your mortgage, it felt like you were investing.
Yes, exactly.
Putting it in a savings account. Whereas now it's more like, so you borrowed 400 grand, in over 25 years, you're going to pay 600 quid a month, roughly, to pay off the balance. That's mental to think like that, because the rest is just interest. And that's why we have a tool to pay. And you have that big figure that shines to say you're borrowing 400 grand, but you'll actually pay back this much. It's horrific. And 6% isn't nothing. If you talk to your parents and say, what was my mortgage? They'll be talking about 16, 15%. But house prices were then 20 grand.
Yeah. So you're borrowing less, but you're paying more interest back.
So essentially, in a really short way, say if you borrow 100 grand or you owe 100 grand and your interest rate is 1%, you're paying £1,000. Over the 12 months of that year, your monthly payments of interest are £83 something. Let's say.
Right.
If you have that same £100,000 and your interest rate is now 6%, that would be £500 a month of your payments is going to service the interest on that £100, whereas previously £83 a month would have gone towards.
And what did you say the second figure was? The other figure?
So if you owe £100,000 and your interest rate is 6%, that's £6,000. Divide that by 12 monthly payments. That's £500 interest. So that's on an interest only.
Yeah.
Payment. So that's.
But if you're paying 100 quid a month for your mortgage at 1%, and you're going to then get 6%, which is fair enough, you're going to pay 400 quid more.
Yeah, but so you're telling me you would still be paying 500 quid a month just for the pleasure of, obviously you're getting the house, but you're not gaining anything. You're not. It's no more yours than it was.
That's on an interest only. But I think a lot of the misconception is that the banks are raking it in now because they've now taken my payment up from 100 quid to 500 quid. But the bank's going to the money markets and stock markets and buying that money at a higher cost.
Yeah, so they're probably making the same margin as they were the last time.
I'd say that.
Yeah. But also they might have bought the money a long time ago.
It depends what type of lender it is and where the money.
But it's the end user. You're looking at it from I'm looking at it from the end user, the customer point of view, and I mean it's massive. I mean, how long has it taken for it to jump from say 1 to 6%? Would you say?
Well, in October it jumped in a month. October 22, it jumped in a month.
That's crazy. Could you imagine that it's gone up from that to that?
Yeah,
and then not can you imagine it? Could you imagine it beforehand?
Well, this is where a lot of the people are feeling the pinch a lot more if they're on interest on mortgage. So landlords in particular have seen their mortgage payments increase so much to the point where it's unviable for them to continue to run, as you say, the business. because the rent isn't covering the mortgage and the tax they've got to pay.
And you can't just pass it on to your tenant. You could put your payment up by 400 quid, but then that has a knock-on effect because to a tenant that means it's more expensive. They look left and right, and most likely the landlord of the other property is doing the same thing. And it is a business at the end of the day. So the only people that are going to be okay with this scenario is those that have mortgage-free properties. But
it's not be too doom and gloom. Rates are coming down.
But this is it. So we're having to imagine this is just you, and we've got. I think we do probably round about 90 existing customer. Let's call it a review each month. So we do feel doom and gloom. We are the Grim Reapers. We come away quite deflated, as I'm sure the customers do, because we're having to not deliver good news every day like we used to. But also for those new buyers who are blind to what used to be and what might happen, it's still quite enjoyable because we work on a budget and they think, oh, that's okay, I can afford this. But it just comes back to the original real way of borrowing, which is expensive. And that's the whole point of it. It was too cheap. It was ridiculously cheap. And it hopefully, like we're saying, not doom and gloom, it will plateau out and will get to a point where borrowing becomes understandable. No one's ever going to like paying interest. That's the whole point of it.
Yeah, but it goes without saying, again, going back to that general consensus of what the lenders are telling us, from the answer to the question we ask every one of them, where do you think rates will sit in 18 months or 2 years' time? Anywhere between 3.5% to 4.5% is what we're being told. Is
3 would be nice, wouldn't it? Yeah.
And would you say that
starting with a 3 would be nice, but I think that is, if you look back through it, it's probably realistic mortgage rate, borrowing rates. 0.99% fixed for 5 years is artificial, and it was always,
So it was too low. It was never going to last.
Yeah.
But so what would it have? I know obviously you're saying you had it.
So Faisal said like 100 quid. How much was it for 100 grand? 1%.
About £83.66.
So just multiply that by 5. So you can have £500,000
Mad.
That is nuts.
500 quid a month, less than 500
quid a month. That's nuts. But put that up to 6%, and you're suddenly paying £2,000, which was 400 grand, wasn't it?
So would you say 3 or 4% is what it should be? If you were taking it as an average,
I think
I know there's no
markets dictate that, depending on so many different factors. But I would say, I think it's just weird. I think it's the concept, the perception people have of it. Because we've been used to such low rates, when we're now going to them and saying it's 5.5%, like, whoa, that's high. Is it really? Maybe a little bit. But I think if I
high compared to what they were on, but
exactly. But but again, we'll go back to the same conversation of in the late 70s, people were paying 14, 15, 19%. Yeah, but your house wasn't. You didn't have to borrow 150 grand to buy a terrace house. And wages were different. You were borrowing 2 or 3 times maximum your salary, twice your salary. Yeah. Now we're begging lenders to stretch to 5.5 times just so people can get on the ladder in certain areas.
It's crazy, isn't it?
It's where it's done. It's had an impact. So the government's obviously got a plan, and it's had an impact to the mortgage market like you wouldn't believe, and it has affected it. The thing I get is customers don't understand it. Why if we're struggling with our energy bills, do the government think putting your rent up, which has been a consequence of mortgage rates going up, and putting mortgage payments up, how is that going to help?
It's not the government's fault. I mean, there's certain policies that can amend, and there is and the Bank of England's decisions are autonomous from government in theory, or apparently. But I think the government's just an easy entity to blame, because everyone relies on them to help you out through bad, troubled times. Yeah. But the good news is, like I keep saying, they are coming down. I've done one purchase client. It's been going on for 2 months. It's a TSB customer. Yeah. It's been brilliant. We've got 5 revised offers for him because interest rates have come down 5 times since he had his initial offer in a 2-month period.
And is it much? Would it make a dent? Is it come down quite a bit, would you say? Or?
Do you know, weirdly enough, because we were looking at doing his insurances for him in readiness for his purchase going through, the payments have come down. It's not a huge mortgage. I think it's about 100 quid, but it's £87 have come down, which means his insurances, in his mind, are free.
Yeah, and
it's a lot of money, isn't it? It is a lot of money.
£87 a month.
To have,
for a first-time buyer that's squeezed,
And when you think that everything else is going up by a lot more than that,
I mean, you can't make any promises, but it's quite hard for us as a broker to budget with you. So we had a customer that said, and we write a suitability report, which is putting in the text what we discussed and what they needed or what they wanted. And now we're having to put in, rather than you had a budget of this and you were happy to pay this, it's you're disgruntled to pay this. But we've actually worked with the budget that they had, and we've had to, over the 3-month period, similar to yours, we brought the rate down, where actually when I'm having to do my addendum to my suitability, because that's what we do, we document things, I'm actually able to remove that paragraph to say we've met your budget. Because you have to send that to the customer. They're not going to sit there and go, my budget wasn't that. We work out a budget to you when you want to buy a house, of course you do. But when it comes to the way that we actually deal with a customer, then we have to be realistic now. And people say, I'm looking around 150 grand and I want to pay this much a month. It's not possible. But it might be.
It might be if you're willing to work until age 147. Well, this is stretch your mortgage to 68 years.
This is the other thing, isn't it? And I know from my personal point of view, looking at it now, like, it does go through your head. You think, well, if you extended it, it will go down by X amount a month. But then you think, that's what you're trying not to have to do. This is the whole thing. I think from a customer point of view, it's so confusing as to what is the best.
But this is where, again, speaking to an advisor really helps. So my appointment last night, the payments are going up by £250 a month.
Yeah.
And there is scope to extend the term slightly.
Okay.
But he was like, I don't want to extend the term. I said, that's absolutely fine. But how important, with the kids being the ages they are and the commitments you're going to have in the next couple of years, how important is it for you not to be stretched every single month?
Yeah.
So what I did is worked out for him, if we extend the term by 3 years, but then once, hopefully, if, as expected, interest rates come down in 2 years' time, what we can do is if you maintain the payments that you're paying now, but your rate is a bit less.
Right.
So by making slight overpayments, and I did an overpayment calculator for him, he could reduce the mortgage back down by 5 years. So he actually pays it off 2 years sooner. But that's in the theory that interest rates come down as expected. So we can give the information.
Yeah.
But he's thinking about that now. He's now actually thinking, well, actually, I could really do with the payments not going up £250. It really stretch us as a family. But I have a plan in 2 years' time to overpay, and particularly with some of the job stuff we've got in line with, and making those use of the overpayment facility to reduce the term back down to actually less than when he was going to originally repay it.
Yeah,
I think that's kind of the way I am, obviously, at the age I am, all my friendship group and people I work with, majority of them have got families, young families. Majority of them find it, this will be the hardest they'll ever find it financially because of dependence and things like that. So I think that's something that, knowing that you could do that, knowing that you could just extend it by a little bit, but in the future, hopefully things go the way they're expected to, it could end up working in your favour. I think it's a good way of looking at it. And I think sometimes you're short-sighted because you're living in the moment thinking, we're struggling now. You're not always going to be struggling as much. You might have more disposable income.
Hopefully, if cost of living comes down, mortgage rates do come down. These people that are on the 2-year fixed rates now, which predominantly, I think most broad advisors are recommending 2-year fixed rates, coming out of this 2-year fixed rate, the conversation I'll be having with the clients is, how have you coped for the last 2 years?
Yeah.
If you've coped, why don't you maintain the current monthly payments? Get rid of this mortgage sooner.
Yeah. And that 2-year fix, the sad thing is the 2-year will be more expensive than a 5 because that's how banks work. And obviously if they're looking at rates. But we can't guarantee it either. We could be wrong, and we have been wrong because we can't predict what happened. But when it comes to affordability, that 50 quid, I see that as, because your example is perfect last night, because that is what you talk about. If you're an advisor, that's what you do. Customer wants to keep the same term. Of course you do. You'd actually love to shave a bit off. But extending it, you need to know what difference that makes, whether it's putting it up by 5 years. But what you're actually saying is, will you retire? Instead of retiring at 60, will you retire at 65?
Are you prepared to?
So when you're doing that 5 years makes so little difference to that 5-year theory. If I said to you, work for an extra 5 years and save you 30 quid a month now, no chance. But it builds in a form of like income protection, because the contractual payment, over the extra 5 years is less, and therefore in harder times you can pay less. But you could still overpay during that period, and you can pay what you can afford. But in 2 years' time, hopefully, like I said, you bring it back down. And it's important to say, especially my customers that have come through this remortgage cycle 3 or 4 times. Do you remember when you called me and you had a 26-year term? And I told you that your payments, instead of being 600 quid, were now going to be 500 quid. But instead of that, what we did was we brought the term down to 19 years, and you're paying the same. In their head, they'd saved 7 years. They'd stopped working 7 years earlier. That's not right. 6 years earlier. 7 years after 26 and 19. Didn't it? So that's how they saw it, and it was brilliant. But the fear of the other way around, wow. What we're thinking is, a customer who comes in to say, I want to buy my new property for a 40-year term with TSB, and I'm buying a brand new house, and we've just moved in with 19, 20-year-old. What we're trying to drill in is that won't be your home forever. And this is your budget today. Your wages will not be that wage forever. You'll also maybe have less because you might have 2 children, triplets. I always bring twins into it. But you never know. So let's not look at just today, which is what the regulator wants you to do, boom. But then they still produce documents that talk about historically 20 years and what might happen. What we want to know is, what are your plans? Is this your forever home? So let's look at this. But also, have you moved into that house yet? No. How much is the electricity? Don't know. Is it warm? Is it cold? Like, do you hate your neighbours? Do you need to go out lots more? Are you going to spend a lot of time in the garden? Are you going to have to spend a lot of money on it? Is there going to be problems? Is your boiler going to break? It's impossible for us to all agree.
You can only do best guess, can't you? Really?
This is it. So this is a time where budget matters more than anything. It's actually one of my first questions. And it always kind of was, what is your budget? Like, never mind what, because they want to know, you want to know, how much can I borrow?
It's interesting when you establish a budget, when you ask that question, what's your budget? Then when you work through the expenditures, and also particularly if it's first time buyers moving out, when you go through all the outgoings they're going to have, that budget changes so often. So again, sitting with somebody to go through all of those and actually come into a realistic budget is so important, particularly in times like this when costs are so high.
Like I said, this is going to be a quick one. We're going to end it very soon. But that links into something very important, because the next podcast is going to be about protection. We're going to bring Joe in. But that budget changes for your mortgage. It's going to now be 850 quid, not 800. Don't care, I want it. Your protection's now going to be this much. Can't afford it. And that's a big thing, because your budget isn't just your mortgage. No. It's your fridge. No. How much does your fridge cost? And that went ridiculous. I mean, personally, going to Aldi, a full trolley never ever cost more than £100, because I never buy the canoes and things like that come with it. I literally buy that, whatever's in the trolley. Now it's £170 to fill the same trolley. And I'm not sneaking stuff in. Like,
no,
you know what I mean?
No, it's the same with us.
That extra, and that's at Aldi. And
it's hard though as well, because at the minute I'm not really drinking, so I'm not buying beers and things like that. And I'm thinking, well,
you're really boring as well, though, aren't you? No.
Oh yeah, it's horrendous. And it's a horrible life. I don't enjoy it.
How did you watch that Sunderland game? What was the score? 5-0.
Nothing
Against
Middlesbrough.
You didn't drink?
It's
probably
I lost my marbles.
You weren't.
But you know what I mean? There's a lot of things that you're cutting back on. Or not just cutting back on, you can't do the little extravagance things. Do you know what I mean?
Oh, absolutely.
So anyway, what I was going to ask, coming towards my questions, were, do you get any advance notice of the rates changing? How do you know? How?
Good question.
Do you find out?
It's a whole podcast on its own. This
before.
Some lenders, and I'll praise them on this because they've always done it, not just recently because it's so important. Coventry Building Society. 2 days notice.
How do they know? How do they know that it's changing? Are they forecasting things kind of? I know without going into it.
It depends. I mean, some building societies, you could argue is easier for them because they're using depositors' monies to lend that, so they know what they're paying out and how much deposit money they've got from their customers. That's the old kind of style mutual society kind of where the money comes from. But you've got the other lenders that will go out to the money markets. And it's for them, we appreciate it's very volatile. So they can't give you 3 days notice because, or 2 days notice even, because the price of money that they buy in changes a lot more frequently. But I think in this day and age, 24 hours is not beyond the runs.
And that's even for big drops or big hikes. You might literally come into work today on a Friday, Friday morning, suddenly find out shit, they're going up X amount.
Yeah.
Bloody hell. And then you've only got Friday to get everyone informed.
We have had emails this year where it said by 6 o'clock tonight, we're pulling it, and that'd be midday, what we're getting, and that's products. And that wasn't uncommon. But we've got to, I mean, we do it again when we talk about budget. We just say, the rates I'm giving you today, man, by the time you go shopping for the house, they will not be the same.
So does that work as in, so say, I don't know, X lender has a lot of different rates, products that you can buy from them.
Yeah.
So basically, if they're going to hike their prices up, they'll just pull the cheap ones. Like, they stop allowing you to get that product.
Yeah.
Is that the way it works?
But with notice, and I think that's part of it.
It's normally now, within 24 hours, I think, is the norm.
But it normally didn't matter either, did it? Historically, the last 10 years, the warning wasn't so perfect. What did annoy you was when a customer was stuck with a particular lender for criteria, and they would pull rates, and then you'd speak to the customer and say, the rates are good, Halifax are changing the rates or whatever, and you could do that. But it's more of at the moment, it's a wave. So inflation was yesterday. Banks are doing what we're doing, have a chat today. They're going to then pass that down the chain, and then over the weekend and Monday, when someone asks me what impacts it has on rates, we find out next week, really. That's
but how does that work with the rest of the market? So say HSBC suddenly hike their or bring theirs down. Does it take a while for all the other ones to cotton on and kind of be competitive? Is it kind of...
I think ultimately the money markets, the swap rates determine the fixed rates available. But also, it's a lot of service standards coming to it a lot. So you could have HSBC that's got market leading rates and they're inundated with applications. They might have the money to lend at slightly lower rates, but because the service standards are so bad because of the influx of applications, they give you notice and withdraw those rates so that they don't come to the top of the tree as much, for example, until they catch back up with the service standard. There's so many variables involved.
It's almost predictable sometimes, isn't it?
Yeah, you can see.
Right at the top for next week it'll be, and you do that because I've been in the process and said the applications come flooding in when you're at the top. Because
I think is like a sort of bystander with it. I find it just fascinating how it works. I still can't get my head around it.
Fascinating or frustrating when you've got NatWest reducing rates twice in a week, Halifax twice in a week, notifications of rates coming through. And when you've got a pipeline of clients who, we're constantly monitoring what rates are doing. So, Halifax announced that, in fact, today I think they're reducing rates again. So you go on to all your clients that you've got deals secured with Halifax, whether they're in the pipeline to switch within that 6 months or the purchasing of property.
So you have
doing the research again, you're recommending the new deal, you're informing the client, you're sending them the new documentation, speaking to the solicitor to make sure that they're not within days of completing, to make sure the new offer goes through. It's time, and this is why
we're mythbusting.
We've been busy.
Because why we've been busy is that, and annoyingly, we are, it's like you changing, me sending you a graphic, you having to change it 20 times and I'm only paying you once.
I know that. That's every job, isn't it?
But that's it.
Yeah.
Isn't it?
No, okay. And one last question. You said, like, you obviously, people coming in asking you, worst thing is people coming in asking you what the rate's going to be like in 2 months' time or something. So my question is, what will the rates be like in 2 months' time? Do you think it's going to go down? Hand on heart. I know it's only your best guess, but
just for security purposes, and we'll end it there before we answer it.
Yeah.
But we'll input that.
We'll let you know in 2 months on the pod where the rates have come down to.
I'm hoping, because I'm going through the process of obviously selling and buying. I'm hoping that next year that rates will be a little bit more attractive. No one's ever going to be happy because, especially if you've been in this. What would I say? The environment of lower rates, then it's always going to be, God, I wish.
It's like a not a blessing in disguise, whatever the opposite of that is.
It's like if you could bottle your electricity. If you could bottle your electricity and your petrol when you were paying less than £1, which wasn't more than 2-3 years ago, then you'd have done it, wouldn't you? And then no one can see. So we don't know, but with your skills and similar to the theme tune, we could just insert whatever we want and override this, so we look good, don't we?
So all right, we'll look back on it.
But if it's got a 4, I think the rest of the market, the property, the new builds, and we can cope with that because it seems more affordable.
The thing is, interestingly, we're saying rates to start with 4s, and 4 would be nice. There's rates starting with 3s, 3.59. but only for existing customers.
And it's a 5% arrangement fee as well. But that helps out a lot of people.
Absolutely, because if they've got a lot of equity, for example, and they can add the fee onto the mortgage, they can secure a 3.59, keeps the payments day to day out.
And that's 5
So 5% arrangement fee. So you're basically saying if it's 100 grand, you put 5 grand up front.
You add it onto your mortgage, you put yourself back on.
Or you can pay it if you've got 5 grand.
Yeah. But actually, it helps the people with the smaller mortgages.
Then it means that you're going to pay less monthly.
Exactly. The nice thing is the market's evolving, the products are evolving to cater for different needs, and every client has different needs. So that, I think, another lender yesterday announced new rates with 5% fees. I can't remember who it was. I'll look up the email, but I think there's going to be more choice. But again, more reason why to speak to brokers, because there is choice out there.
But it's looking better than it was 2 months ago.
Yeah, and I think it's looking better now. I think next month we're going to set it up. I think next month, given October's data, because there's talk in the media and also if you read the financial papers, that inflation has come down. It just didn't last month. Yeah. If that does come, we've seen it, like electricity has come down because of the new the price cap changes. So that's going to affect us. The thing is that inflation matters because that's what hits your pockets, but it affects the mortgage market. And we're speaking to lenders who are, I wouldn't say optimistic, but what they're saying is we kind of borrow over the worst of it. But they're saying it, not us, because we don't know. And next year looks a bit more positive. In fact, it's going to be very busy because, like Baz says, the ticking time bomb with those 5-year fixes is coming up. And that's where we're going to be helping customers, is the ones that already have a mortgage. The ones that don't, they're going to learn as if this has never been anything different. So that's great, because if you're moving out, it's going to be expensive. It should never really have been that cheap.
I think for me, though, what will be beneficial, and if there's other people like me, would be to have a podcast just on the basics of stuff like you were saying about the interest rates, about the inflation and all that. I just 100%. Think it's quite a handy thing to, because I know I'm very clueless now, but I'm not as clueless.
And we probably will do. We'll definitely need either Faz there, like on Countdown, where he's got his laptop and we can show some
dictionary corner.
100%. Because it is important. Like a dummy's guide, isn't it?
But it is. But that's what I am, right? And I think a lot of people are, and this is why this is an important thing to talk about, isn't it?
That is. And it's been good to get back.
It's been good.
We've 70 minutes over what we should. Good. Today's podcast was stopped doing the Mythbuster podcast, and we certainly haven't. We are back. We've been busy. We've all been busy, and we want to get more out there because it's good to talk. Also, I've learned quite a bit.
Yeah, definitely.
Like, you know what I mean? It's nice to get, especially when Faz comes up. It's get his take on it. Listen,
it's just so much better than you, isn't it? That's the thing. It's just got a lot more about him and knowledge-wise. It's good. I feel like a polished podcast.
With that. Right. Thanks, guys.
Thank you. Cheers.
Thanks for having me on.